This is Praveen. Today I came up with one more lesson from economics part, money and credit. In this part we're going to discuss about the evolution of money and the functions of money, banks, importance of bank, reserve bank and its functions, and very important thing we focus on in this particular session, that is regulation of money supply and credit control measures taken by RBI, quantitative and qualitative credit control measures. All this we going to discuss. Let's start from the evolution of money. The money is a very important thing, that is a very important discovery of man, and it is very important thing in day-to-day transaction, which is the means of payment, and it measure the commodity and store of value. According to the Robertson, money is nothing but which is widely accepted in payment for goods. That is nothing but money. The evolution of money. Here are some of the very important stages of evolution. That is, there are 6 stages. One is barter system. Barter system, in the previous classes we have already undergone. The barter system is nothing but the exchange of goods for goods without money. Exchange of goods for goods without money. This is the thing which was existed in older days. It was very difficult method for trade and commerce purpose, and very difficult in transaction, so that the problem is the problem of double coincidence and valuation of animals in exchange became very difficult, so that the barter system was stopped. And the second thing is commodity money, in which the particular thing and commodity has been regarded as money. That is commodity with a specific size and weight was adopted, like cattle, sheep, teeth, all these particular things were adopted as a commodity money. And metallic money, in which the metals are used as a coins, like gold and silver, bronze, all these particular metals are used and minted different types of coins, and which were very suitable medium of exchange, because standard weight and fitness, and very acceptable, portable, and can be divisible, so that metallic money became very popular those days. Paper money. Paper, the traders began to carry the written documents as evidence of money. Written documents were regarded as paper money, in which the documents were issued by government. They were called as promissory notes. Then later government started to print out different denomination notes by RBI. For example, rupees in India, and dollars, pound, euro, yen, yuan, all these particular currencies, paper notes were printed in different countries. Next stage is bank money. Bank money is nothing but check is also considered as money. Demand draft, DD, and deposit receipts, all these considered as bank money. Even ATM cards, credit cards, all these regarded as bank money. The last one is plastic money. Now we have been using all ATM cards using PIN, personal identification number, digital money, e-money. We have been transferring money from one person to another person, and one place to another place by using internet and online banking. All these regarded as plastic money. Plastic money, nothing but ATM cards and credit cards we have been using. Functions of money. What the money can do. There are 2 types of functions, primary and secondary, in which primary functions, it is a medium of exchange and means of payment. The very primary function of money is it is the medium of exchange and means of payment. and it measures the value and prices of goods expressed in rupees. All these primary functions. Secondary functions are standard of deferred payment, which means the money can be facilitates for future payments. A particular person are assured to pay the sum of amount in future days, facilitates future payments. A store of value, possible to save and store for future purpose, and can be accumulate the money. And stand for value, the transferring purchase power from person to person and place to place, can be send the money from person to person and place to place. Banks, according to Banking Regulation Act 1949, defined the banking company. There are 20 public sector banks in India, and rural banks are there, private and cooperative. All these particular banks are registered with RBI. Very important thing, in 1969 14 banks are nationalized, and 6 banks nationalized in 1980. Very important thing and to be noted, 14 banks and 6 banks in 1969 and 1980. Let's move on to importance of bank. Why banks are very important? Banks play a very vital role in economic development and mobilize the savings of public, and it can very helpful in formation of capital, and provides a way of remittance of money to account holders, and gives the loans to the borrowers, and agriculture purpose, industrial purpose loans are available, and issue the DD credit cards and debit cards, and investing funds on securities of government, and higher the rates of interest on fixed deposit FDs. All these what banks does. And Reserve Bank of India. Reserve Bank of India established in 1935 1st April, and it was nationalized in 1949 1st January. What are the functions of RBI? RBI functions, let's sum up. First function, the monopoly of note issue, particularly rupees RS and above, and 1 rupee on behalf of government, issuing the notes. First function. And bankers to the government, it works as a bank of government and accept deposits of government and collect the money like taxes and all, and charges, issue the government bonds and treasury bills. It is a banker's bank and regulate the activities of bank and guide. RBI provide credit to the banks as well. And the national clearing house, bank is a national clearing house, settlement of transaction across banks, schedule interbank claims as well. And controller of credit, bank is a controller of credit, regulates amount of credit issues by bank, and it is a custodian of foreign exchange, manages foreign exchange rates as well as resorts buying and selling the foreign currency. Promotion of banking habits. All these the very important functions of RBI. Now the last one is regulation of money supply. Very important thing, regulation of money supply. How the RBI regulates money supply. Money supply of the country is equal to currency notes plus coin issued and savings current account balance. So total circulation of money in the country, it includes currency notes plus coins issued and savings current account balance, togetherly the money supply of the country. There are two important things there, demand deposits and time deposits. What is demand deposit? Bank is liable to pay on demand of customer, the bank has to pay. That is demand deposit. Time deposit is nothing but the customers are usually save the money for future purpose, in a particular account, that is fixed deposits. The measurement of monetary or money supply, how we can measure the monetary system and money supply of the total country's economy, which types of different circulation of money is involved in total monetary system of one country. So here is we go. M1, it denotes notes, coins and demand deposits. M1 stands for. M2 stands for M1, which I mentioned earlier, M1 plus post office savings, that is M2. M3 is equals to M1 plus net time deposit. Time deposit, we have already came to know that what is time deposit. M3 is nothing but M1 plus net time deposit amount. M4 is nothing but M3 plus total deposit with post office. All these M1, M2, M3, M4, it is monetary total system of one country, the total money supply in the country, M1, M2, M3, M4, which includes, I previously told that. Here is let's have some important terms here is mentioned: narrow money, broad money, inflation, all these things. What is narrow money? M1 and M2 is referred as narrow money. Broad money means M3 and M4 is regarded as broad money. What is inflation? Inflation is a higher the supply of money without supply of goods and services leads to rise in price of commodities is called inflation. During inflation, all the goods and services price goes very high. Such a particular economic situation condition of one country is called inflation. The very mild increase in prices is a very tonic to the economy. If it is very rapid, that affects a lot on economic system of one country, and purchasing power, income distribution and investment, that totally disturbed. So mild increase in inflation is a very important thing, very tonic to the economy. And the last we go, that is credit control measures. Credit control measures, here we go in two ways: quantitative and qualitative. First one, bank rate policies. How a particular RBI controls the money supply, controls the currency system in India. First one way how it control, through bank rate policy. The rate at which RBI lends funds to commercial banks through repo rate and reverse repo rate. In this way, it can control the credit. Repo is nothing but the rate of lending money to commercial bank is called repo rate. Reverse repo is nothing but the rate of borrowing money from commercial banks is reverse repo rate. By controlling these two, repo rate and reverse repo rate, RBI can control the credit, and this affects the interest rate and deposits. Open market operation, buying and selling of government securities by central bank. And very important thing are there here: CRR and SLR. CRR is nothing but cash reverse ratio, and SLR is nothing but statutory liquidity ratio. CRR, bank required to reserve deposits with RBI, that is CRR. SLR, bank required to have minimum cash within it, that is SLR. By varying these two, CRR and SLR, the RBI can control the flow of credit to the customers and other means of loan. And one more thing, that is quantitative. Change in lending margins. In this way, the RBI can control the flow of credit. Collateral security margin against particular security is reduced or increased. In this way, it can control. Credit rationing. Credit rationing is nothing, maximum amount of credit given to particular use or sector is credit rationing. Moral caution is the third one. The method of pursued in banks to advance credit or reduced through letters or circulars. Through circulars and letters, it can control. Direct action, that is taken by central government against commercial banks, that is direct action. Directly by intimating to the commercial banks, it can control the credit flow. In this way, RBI restrict the flow of credit and regulate the money supply and consequent effects on price and economy. So this is we have discussed about money and credit in this particular part. Thank you for joining. Thank you.